But
All right. So start over. Good morning again. So my name is Will Tiao. As Anthony said, I am the director of the commercial division here at the Collective Realty. I specialize in investment properties. People who are buying investment properties, they could be commercial or residential. Primarily, I do multifamily. I would say about 70 to 80% of my deals are multifamily. And so it is, as someone mentioned, it's its own special beast when you're buying or selling a multifamily property. I also do property management, and as Anthony said, I'm an investor and developer myself. So I've been pretty ensconced in the multifamily world, honestly, since I can remember. My family, my father, got into buying kind of small apartment buildings, and then eventually grew his practice into several hundred units that he was managing. I've, since then opened up. That was in the Midwest, and then now I'm here in Los Angeles and kind of doing something very similar. So, been doing this for a long time. There are, as Anthony said, we do this real estate investing 101 class every year. Some of you have seen this presentation multiple times, but I think that the reason we do it is because it's always good to review what the fundamentals are. And for some of you, this is the first time maybe that you're really looking at the fundamentals of how to evaluate multifamily real estate and what are the things you need to be considering as you're moving forward and potentially becoming a multifamily investor yourself or representing multifamily investors. There are very, very, as has been mentioned, specific issues when it comes to investment properties, multifamily specifically. So with that, I'm going to get started with the presentation. Da, da, da. Okay. Can everybody see my screen? Awesome. Okay. So welcome to Real Estate Investing 101. Hopefully, after this presentation, uh, not necessarily you'll be a pro, but you'll definitely be conversant in the issues that you'll be facing or your clients will be facing when it comes to investing in multifamily properties. Let's see. Okay. So I'm not the type of person who likes to just talk to people. I like to make this interactive. So I'm going to ask you guys some questions. Number one, why? Why? What are the advantages of investing in real estate and in multifamily real estate in particular? Can anybody tell me? Feel free just to, you know, unmute yourself or, um, throw it out there. No reason, no good reason to invest in real estate?
we got here in the house passive income. Yeah.
Passive income. Okay, what else?
Depreciation.
Appreciation. What else?
Equity growth.
Equity growth. Okay, kind of same thing as appreciation, but okay. What else?
Generational wealth.
Generational wealth. What
This
else?
meeting is being recorded.
Okay. Tax benefits.
Tax benefits. What else? Okay, that's a good start. That's a good start. Okay. I came up with a list of
Tax
a lot of my
benefits.
own that mirrors a lot of what you're hearing. So, number one that a lot of people hear is passive income, right? You get to invest, you get to put your money into something, and then that asset makes you money in your sleep, right? That's the idea, when you're able to collect income on an asset. Um, Equity appreciation, right? So as somebody said, like the idea that like, okay, you have the asset, it earns you money, but it also the asset itself can raise in value, right? So that's two. The third, which I did not hear anybody say, Marty, I'm a little surprised you didn't mention this, is leverage, right? So, in very few cases with regards to certain assets, are you allowed to say put only 20% down or 10% down or whatever, or in some cases 3% down, 3.5% down um, on an asset. And so leveraging, meaning having a bank, a lender, or a non-bank entity, it could be a private entity, whatever it is, using leverage to be able to buy a full asset, is a huge, and that's considered standard, as we all know, in real estate. Something Zoe said, tax advantages, right? So there are lots of tax advantages. Depreciation was mentioned, right? Certain write-offs are can be used with real estate. So there's lots of tax advantages. And oftentimes we've had tax experts here to kind of elucidate kind of what those things are. And then finally, and I didn't hear this either, is the 1031 exchange. So, and this is actually going to be one of our upcoming seminars. We're going to talk specifically about the 1031 exchange. But what in essence is in a 1031 exchange is just to make things easy. Say you buy an asset for $1 million, and a few years later, the equity appreciated and that asset is now 500,000, right? So now the asset's worth 1.5 million, right? If you bought $1 million worth of Apple stock and then sold it later for 1.5 million, you would pay capital gains taxes on that full 500,000, right? And generally speaking, that's about 40%, right? If you're in the state of California, it's 23% federal, 15% state, okay? But with real estate, specifically investment real estate, we have something in the tax code called the 1031 exchange, which basically allows you to trade what's called like kind for like kind. So if you have an investment property and you buy it for $1 million and then you sell it for 1.5 million, as long as you reinvest those proceeds, the full 1.5 million into something else, you can defer the capital gain. And that's huge. And there's no other asset like that, basically, in the tax code at all. So that's a huge, huge advantage for real estate. They back in 2017 in the first Trump administration, there used to be 1031s for like businesses and now it only applies to real estate. So that's a major, major plus for real estate. All right. It says my connection is unstable. Can you guys hear me still? Okay, good. Okay.
You're good.
Tell me, why would you not invest in real estate? What's the downside to investing in real estate? Can anybody tell me?
Cost.
Active
Cost.
participation.
I'm sorry, say
tenants,
that again.
Active participation.
maintenance,
Okay, cost, active participation, maintenance.
Not
tenant
being able
issues.
to not being able to resell it.
Not being able to resell it. What else? Can be tough to sell.
liquidity,
Liquidity. All good. All very good. Okay. So let's see. Let's see what I came up with. Okay. So number one, somebody said cost, right? Well, basically, yes, it does require capital, right? A lot of people think, oh, I can just put, some people think that they can put 0% down, but almost that never happens, right? You're going to have some capital and oftentimes substantial capital in order to purchase real estate, right? Somebody said it's not liquid. That's true as well. So it can be tough to pull your money out. Whereas with stocks or, other types of very tradable assets, you should be able to sell those things quickly if needed, right? To get your money back. With real estate, it can take some time to be able to get your money out. So that's something to consider. I heard active maintenance management. Management's a big deal, right? They call it the 3 T's. What are the 3 T's? Anybody? Anybody know the 3 T's? Tenants, toilets, termites. Okay? That's what management is. Tenants, toilets, termites. You're going to be dealing with all 3 of those things, especially when it comes to multifamily. Something I didn't hear anybody talk about was the expenses that come with real estate, right? You have property tax, you have insurance, you have utilities, you have maintenance. All those things cost you as the owner or your client. So something else to consider. Another thing I didn't hear, legislation or legislative issues, right? You're like, so there are legislative risks with owning particularly multifamily real estate, right? You have rent control, meaning certain jurisdictions, you're only able to raise the rent a certain amount, or you are not able to evict tenants without cause. Eviction moratoriums, okay? Meaning, like sometimes, say during COVID, you were not, even if your tenants didn't pay, you were not able to evict them. In the city of Los Angeles, you cannot evict a tenant unless they hit a certain threshold. And oftentimes, sometimes those thresholds are more than 1 month's rent. Okay? So these are all potential issues when it comes to investing in real estate. I always like to point out everything, both the pros and the cons, before getting into any investment so that people go into it with eyes wide open. And so you can be prepared either way, both for the benefits as well as potentially the drawbacks. All right. Now, one of the probably the biggest question I get, right, is how do I know if something's a good deal, right? So how do you know if what you're buying makes sense financially? Okay. So there are 2 major metrics when it comes to evaluating investment real estate, in this case, particularly multifamily, right? So the first is something called the gross rent multiplier. If you're going to write down 2 things, these are the 2 things you want to write down, okay? The first is the gross rent multiplier, also known as the GRM, okay? So let's say and that is calculated by the list price of the property, like what you're purchasing the property for, right? Divided by the yearly income of that property. Okay. So let's do a quick I'm sorry, but I'm going to make you guys do a little bit of math here. Okay. Let's say you have a list price of 1,200,000. Okay, 1,200,000, and your yearly your income is 10,000 a month on this property. Okay, so your list price again is 1.2 million, and your monthly income is 10,000 a month. What's your yearly income? Anybody?
120 we have here.
120,000, correct. So you have 1.2 million is the purchase price and 120,000 in yearly income. Can somebody tell me what the GRM is? What the gross rent multiplier is?
10.
10. Congratulations, that is correct. So if you have a $1.2 million property and you have $10,000 in income, the GRM is a 10. Now, let me ask you a question. Anthony and the Collective, you guys are in West Hollywood. Is a property, if I show you a property with these numbers, right? It's worth 1.2 million. and the income is 120,000 and the GRM is a 10 and that property is in West Hollywood, is that a good deal or not?
Yes. Everybody says
Incredible.
yes.
That's
Why?
probably a pretty rundown property to find something for 1.2 in West Hollywood.
Why? Why is that a good deal?
This is, yeah, it's not, remember, it's not about the price of the property, it's the GRM, what the income, right? So yeah, West
Why
Hollywood, you
is
might
it a
not find
good
something
deal?
for 1.2, but yeah, why is it a good deal?
Can somebody tell me?
Even just with the income in 10 years, you're going to be even, but you also have appreciation.
Yeah, in 10 years, you'll pay the property off plus appreciation.
Yeah, but okay, so I have a GRM of 10 in Barstow. Is that a good deal? Same idea, right? It takes me 10 years. So why is it a good deal?
Because the property in West Hollywood is going to be, the value is going to be much higher than in Barstow.
Yeah,
Because
typically,
the
yeah.
GRMs in West Hollywood are much higher. The GRM in West Hollywood is what? Can anybody tell me?
Or
No higher, it's going to be like 18, 19, 20.
I'm going to say it's around 14. Okay. So what does that mean? It means if you're a smart investor and you see this deal, okay, you see that you can buy a property for a 10 GRM, you could literally turn it around and sell it for 14 GRM because you know the market. That's what a smart investor does. Sorry to yell at you. Okay? But I'm trying to get this, like, this is important stuff. You need to know your markets and you need to know your GRMs in those markets. That's what defines a good investor versus a bad investor. Okay? Let's use another metric. This is the second thing. If you're going to write down anything, you want to know what it is.
Well,
Yes.
maybe do you mind just from your knowledge, like maybe give a couple other cities?
Absolutely. So generally speaking,
yeah.
generally speaking, if you're in a better area, the GRMs are higher, right? Like I said, right now in West Hollywood, it's a 13, 14 GRM, right? The closer you get to the beach, they get higher, right? You go to Beverly Hills, it's 15 or 16. Same with Santa Monica, okay? But you go east, you go to Barstow. What are the GRMs? They're like 6 or 7. Okay? So basically, the better the area, the higher the GRMs. The more developmental the area, I'll put it that way, right? The more risky the area, the lower the GRM. Does that make sense? Clear?
Yes. And
Yes.
Kobe had a question. Do GRMs differ for duplex, triplexes, or quads for an area, or are they similar?
Once again, it depends, right? There's a big, we'll talk about this a little bit, but there's a big difference between 2 and 4 unit properties and then 5 units and above. Can anybody tell me what's the difference between 1 to 4 unit properties and 5 units and above?
whether it's commercial.
Commercial versus residential.
Commercial versus residential, what does that mean? What's the difference?
Higher rates
Higher rates of what?
on the loan.
Higher rates on the loan. Meaning a higher interest rate?
Typically, right, on a commercial, you're going
Not
to pay more.
necessarily. Not necessarily. No,
Oh, okay.
it's not about the higher interest rate. It's about something else.
On the loan front, you're probably going to have shorter term.
Able to
There's
use
shorter term. There's a shorter term, but what else? What's the big deal?
able to use the income for the loan for the financing.
No.
Can you ask the question one more time? I apologize.
So what is the difference?
Besides the down
What is
payment.
the difference between a 1 to 4 unit property also known as a residential property, and a 5-unit or more, also known as commercial property.
So, I mean, what is the difference on what? On what's the major
One
differentiator?
qualifies the borrower, the other one qualifies the building.
Thank you, Joe. Winner, winner, chicken dinner. Good job. Okay. So 1 to 4 unit properties are financed primarily on the borrower, right? Marty has done this many times with myself and my clients, right? So,
But I will say though, like that's not always, but just primarily you qualify the person with the business of the building, but the borrower comes into the equation and they could supplement that income. But just throwing that out there.
yeah, exactly.
Don't exclude
Obviously,
the
I'm not a
borrower entirely.
lender. If you want lending advice, you go to Marty.
But what Joe said is correct though. But
exactly.
there are exceptions to the rule where
Yeah,
we
there's
need to get more income.
there's exactly. That's correct. But generally speaking, 1 to 4 unit properties are financed primarily by the borrower, based on the borrower. 5 units or more, they're generally looking at the building itself.
Yes, I mean,
Okay? And when you do that, what happens is that oftentimes that requires a higher down payment. I will give you a real life example. I had a 5-unit building in Echo Park that was listed for about 1.6. If that had been a 4-plex, I probably would have sold that no problem, because it would have been easy to get 25% like down payment for something like that, which is about what most lenders require. But because it's a 5-unit, it was mostly on the commercial financing end. And because of that, most banks were requiring 40% or more down. That's a big difference between 25% and 40%, right?
Can I give some insight on that for a second?
Yes, please go ahead, Marty.
So just to give you guys context on that, it's a lot of times for a lender, your clients would come to us and say, hey, I only want to put 20% down. Well, you guys don't have 20% down financing for commercial loans. We say, well, of course we do. Well, we do 20, 25, whatever. I mean, if it's an incredibly well, so there's different options, right, that we could do. And then we look at the rents and we compare what they were buying it for. And that 20% no longer holds true, because the servicing of that debt does, like the amount of money that property brings in doesn't service that payment essentially. So therefore they're going to have to put a lot more money down to service that payment or the debt that they have on that property. So the 20% down question holds true for residential. So there's a hard and fast rule that says if your income qualifies you for this income, for this property, then you could put 20% down, 10% down, 5% down. That varies with commercial properties. It could be as much as 40% down, 50%, 60% down. So I just wanted to let you guys know.
That is that's spot on. And by the way, Marty, you came in late. So do you want to introduce yourself so people know who you are?
I am Will Tiao's assistant, Marty Carey. No, I'm Marty Carey. I'm the CEO, president of Artstone Financial, and we do residential lending, but we also have a commercial lending division as well too. But here to just add color to what Will is saying and be supportive of the conversation. So, if you have any questions in regards to lending, Joe, myself, Nune are all here to support your questions.
Thank you, Marty. It's great to see you. Okay, so next, now this is kind of the GRM, the gross rent multiplier, is kind of a rough, it's more of a rough estimate, right? We're just taking gross yearly income, but we're not taking in expenses, right? So for something with a little more color, as Marty says, there's something known as the capitalization rate. Okay? The cap rate is a little bit more nuanced. Okay? The cap rate is calculated by taking net operating income. Okay? So that's not gross, but net. Okay? So that's your gross income minus your expenses divided by the purchase price. Okay. So it's a percentage rather than a whole number like the GRM is. Okay. So let me go back to that example that we had. Okay. Let's say we're back to we have 120. Let's go back to our original example. This building makes 120,000 a year. Okay. But let's make it simple. Let's say there's $50,000 in expenses. So $120,000 gross income, $50,000 in expenses. What is the net operating income? Anybody tell me?
70K.
70.
70K, correct. Now, we're keeping our original purchase price of 1.2 million. Can somebody calculate the cap rate, the capitalization rate on this?
5.8.
And how did you get that?
70 divided by 1,000,002.
Correct. 70,000 divided by 1,000,002 is 5.83. Okay, I'm going to ask you the same question that I asked you before. If there's a property in West Hollywood with a cap rate of 5.83, is that a good deal or not? Can anybody tell me?
What I don't understand is is the higher number a better number or a lower number a better number?
Excellent question. Excellent question. The answer is it depends. Okay. A higher cap rate, it's also kind of like estimated that that's your rate of return. Okay. So obviously, higher cap rates means you get a higher return. Lower cap rates mean you get a lower return. Okay. So I'm going to ask the question again. You have a 5.83 cap rate building in West Hollywood. Is it a good deal or not?
No,
No. Why?
because the cap rate is low. You want the cap rate a little higher, wouldn't you?
That's a question. That's a good question. Can anybody answer that question for Lee? Is 5.8 low for West Hollywood? The answer is no.
Like average.
The answer is cap rates in West Hollywood are closer to 4.5. Okay? So if you have a 5.83 cap
You are winning.
in
It is
West
winning.
Hollywood, you're winning.
You are winning, yeah.
You're winning. Okay? But once again, real estate is location dependent. If you have a 5.83 cap rate in Studio City, if you have a 5.83 cap rate in Echo Park, that's actually about market. Might be even a little lower than market. Might be a little, you might be actually overpriced. Because cap rates in those areas right now are in the 6s. Okay? So everything depends on the area. That's how, once again, I'm going to repeat what I said. That's how you differentiate between a smart investor and a not smart investor. You need to know your cap rates and your GRMs in those areas. Okay? So, when you look at particularly a multifamily listing, you're probably going to look at different numbers, right? So, particularly in Los Angeles, where as we discussed, Los Angeles, West Hollywood, Beverly Hills, Santa Monica, anywhere that has rent control, which is most areas of Southern California, right? There are usually two numbers that you'll look at. One is actual rents, and the other is pro forma rents. Can somebody tell me what a pro forma rent is?
Pro forma rent is what you can scale the rents up to. So maybe you can
Correct.
add some.
So that's market rents, right? Pro forma is market rents. Can somebody tell me why there would be a difference between actual rents and pro forma rents?
Rent control.
Rent control, right?
Yeah, rent control, old tenant.
If you have tenants who have been there a long time, sometimes those landlords have not kept up with the rate of inflation, the rate of the market, right? So you could have a delta, a difference between what the actual rent is and what the market rent is. Okay? So that's very important as you're calculating your GRMs and your cap rates, right? Because that difference is going to be the difference in the value of what the property is worth. Okay? That's why it's so important. Things to think about when you're purchasing a multifamily. Yes, Joe.
So then when you're calculating the GRI or anything, you're using the pro forma or the actual?
That depends on what you're looking to do with the property,
Okay.
right? First of all, it's not GRI, it's a GRM. Sorry to sorry to I'm very precise with my terms.
I agree.
Right? Because you want to look good in front of your clients, right? You want to be
Right.
clear that you know what you're talking about. So let's be clear. It's a GRM, it's a gross rent multiplier, right? So there's a pro forma and an actual, right? When you're looking, it depends on if you're looking to sell or you're looking to buy, and depends on if you're like how you're pricing this, right? And a lot of times, what I find with a lot of the listings I come across is that they're pricing at what pro forma is, at what market is. But then I look at their numbers and I'm like, wait, but you're not making that much money. Your actual is much, much lower. So why are you priced at this when you should be here? Right? That's once again, when like as an agent or as an investor, when you're looking at these things, you want to make sure that you're looking at the right numbers, right? You want to make sure that the actual numbers are supporting the price. Okay? Because if not, you're overpaying. Okay? What some people do, I have done this myself in the past, where I've been like, okay, I see something with a really low cap rate and a really high GRM, and I'm like, that's a good deal. And you're like, what? Why? Because you see what it could be, right? You take into account what it would cost you, the investor, to get that property up to market.
Mhm.
And if you think that it's worth getting it up to market, then that delta, the difference is yours, right? So those are things that you want to think about when you're, as the agent, if you're listing the property or if you're the buyer looking to potentially purchase the property. Okay? Now, let's get to how to hold title because this is very important. Okay? Most of us in an ideal world would just buy things ourselves, right? We wouldn't need partners. But realistically, as we discussed, like buying real estate is expensive. It requires capital reserves that most of us don't have a ton of, right? So a lot of times you could buy it by yourself. You could buy it with your spouse. You could hold that in your own names or in a trust. We've had estate and trust and estate lawyers come through, talk about the importance of holding in a trust so that if something happens to you or your spouse, that it goes to your children without going to probate. Okay. Oftentimes you could hold it in partnership, right? You could have other investors, you know. Everybody in this room, we could all decide that we want to buy a property together, right? How would we hold that? What type of partnership would that be? Would it be tenants in common, where we each own a piece of it, where all of our names are on title? That's a lot of names, right? How many people do we have on this thing right now?
15.
20 something? 30 something?
Yeah.
A lot of names on title, right? So if it's just, say, me and Anthony, right? Maybe, and say we were related, we could buy as joint tenants, right? So that if something happened to me, I died, then my half goes to Anthony, or Anthony dies, his half goes to me, right? Or we could create an LLC, right? We could create a corporation, and then we each own pieces of it, that LLC, and then one entity, that LLC, owns the property, which is what I usually recommend to my clients because of the liability, right? Because if something happens, which could happen because there's tenants on that property, if you get sued for that property for whatever reason, then the lawsuit can only apply to that property, right? What type of property are you looking for if you're thinking about investing in multifamily? Do you want to just invest in the land? Are you looking at fixers, right? Something that you know, once again, where you could buy something for maybe a little cheaper, but then fix it up, sell it for more? Are you looking for something turnkey? When I talk to beginning investors, I usually recommend that they look at a turnkey property. Turnkey means literally turn the key and it's ready to go, right? The thing is, you're going to pay a lot more for a turnkey than you are for a fixer, right? What does that mean? Your GRM is going to be higher or lower for a turnkey? Higher, lower? Higher. GRMs that are higher are more expensive. Okay? So if you're buying a turnkey property, usually your GRMs are higher. If you're buying a fixer property, your GRMs are lower. Let's use the same thing with cap rates. If you're buying a turnkey property, is your cap rate higher or lower?
I don't know.
Your cap rates are usually lower on turnkey properties because you're getting a lower rate of return. And on fixtures, you're getting a higher one, right? That's what your hope for is anyway, in terms of what you hope to get, right? Other types of properties you might want to consider are something called triple net properties. Triple net is where basically oftentimes doesn't apply to multifamily, but sometimes there could be master leases. And in that case, you're basically having one tenant pay for everything. Okay. Usually it more applies to commercial properties, like, say, I don't know, a Jack in the Box or a CVS. You're buying the real estate and then the tenant pays rent and expenses and taxes. Okay. That's triple net. Okay. And then, as we discussed, there's a big difference. Are you buying 1 to 4 units or are you buying 5 or more? Once again, the difference is the financing. In terms of financing, how are you financing this? Right? Like, how are you purchasing this? Do you have cash in the bank? Do you have that much cash in the bank? Good for you. That's great. A lot of people don't, right? So oftentimes people have to go through Marty, go through bank financing. Marty also does private financing, right? So for non-bank entities, I think I read the other day that half of all loans in this country are non-bank entities. They're private financing, okay? Another is syndication, right? What I just talked about. What if we all 30 of us on this call decide to buy a property together? That's called syndicating. That's when you're basically taking on a bunch of investors to purchase something. Okay? That requires its own set of rules. Very important, probably, to get a lawyer involved to draw up the correct paperwork, because you can get yourself in real trouble if you don't do it correctly. I've done several of these. So very, very important. I'm invested in some of them. Okay. So all very important. Think about what your goal is, right? Let's go back to what the advantages of
Yes.
real estate are, right? Are you looking for cash flow? Are you looking for appreciation? A lot of people are like, well, I'm looking for both, right? Duh. Right? I want both. But oftentimes there's a trade-off, right? The trade-off is you either get cash flow or you get appreciation. Very rarely do you get both. Okay. I'm originally from Kansas. Okay. Let me ask you guys a question. Do you think that properties in Kansas get more cash flow or get more appreciation?
Cash flow.
Cash flow. Why? Because it's Kansas. I love Kansas. I'm from there, but it's not a high growth area. Okay. Investing in California and Los Angeles specifically, and West Hollywood specifically. Are you getting more cash flow or are you getting more appreciation?
Appreciation.
Generally speaking, it's been appreciation over the years. I mean, the rough, and Anthony, please correct me if I'm off on this, but I've read this multiple times where the average like real estate investment in the Los Angeles area like doubles in value every 10 years.
Yeah,
Right?
that's about it. Mm-hmm.
Right?
Yep.
Let me tell you, I've invested in Kansas real estate in 10 years. Did I make double my money? Absolutely not. But I did get cash flow. Okay. So you have to think about what you're looking for. Are you looking for a quick flip? Right? Are you looking to buy something? Like I said, you buy something for a 10 GRM and you immediately sell it for a 14 GRM. That's a quick flip. Right? Or are you looking to hold it for a long period? You know, those are all things to consider. Are you looking to potentially 1031
Excuse me.
your investment?
Why would you do a long-term hold? What's the benefit to that?
Good question. Can anybody answer that question? What's the benefit of holding real estate long term?
Is it like an underappreciated area and you're thinking the market's going to come back? Or is it like a culturally, architecturally significant building and, it'll appreciate?
I'm throwing this out to the group. You guys are all real estate professionals. So tell me, what is the advantage of a long term hold? Can anybody tell me?
Cash flow and appreciation and tax shelter.
All of those things. Anything else? Sorry, I did. Oh, sorry, Anthony, you're a little frozen again.
It's okay. No, we're good. We're good here.
Okay, so, say it again. Now you're back. Now you're back.
No, we're good. We said stability. Yeah.
Stability, yeah. You have an asset in your portfolio that continues to make money, right? I have a client right now. I'm managing his duplex in West Hollywood. It's like it's that area in West Hollywood that's like just west of San Vicente, right? Next to Beverly Hills. He's a corporate lawyer up in the Bay Area, makes a decent amount of money, but that property he bought it at a price where now it's worth $1 million more than he bought it for, and he's getting income. So he's like, why am I selling this property? Why would I sell it? It makes me money, and I'm sitting on $1 million in equity in dirt, and it's just going to go up. That's why he's holding it, right? Everybody has different reasons. And then eventually one day, maybe he will 1031 that property, and buy something bigger with more cash flow or whatever it is, right? And then eventually he'll probably pass, and then his kids get a step-up basis. Now we're getting to really advanced PhD level tax stuff. But basically, it resets your tax basis so that the kids could sell it and have no capital gains. Okay? How do you manage the property, right? What did I say the 3 T's were?
Tenants, toilets, and termites.
Tenants, toilets, termites. Who's handling these issues? You? Do it yourself? Or do you hire a property manager?
Property manager.
All depends. All depends on what your tolerance is for the 3 T's. Right? I get a lot of calls because of the 3 T's. Okay? What's your next step? If you're looking to invest, right? How do you find your listings? You look for them online. You find off-market listing. How do you find off-market listings? You come to places like this. We discuss off-market listings all the time. Okay? Deals have been done in this room. Okay? You network. You find other agents who work in this field. Okay? People who are in this field daily. You work with the right team. You constantly educate yourself and network. How do I know what the cap rate is in West Hollywood, Beverly Hills, Santa Monica? Because I'm in those markets every day. Every day. Okay? I look at those numbers. Okay? And so everybody here who wants to be involved in these things needs to know this stuff so that you're ready for your clients or for yourself if you're thinking about putting in money into something. All right? That's it. That's what I have. If y'all have any questions, this is my information if you guys want to reach out. I would say that I want to open up the floor not just to questions, but also to deals. I've got some multifamily deals I'd love to share. And just want to, touch base with anybody.